Is the market right to be universally positive on bonds heading into 2024? Or are there some key risks investors might be missing? And what are the most attractive and least attractive areas of the bond market? These are the 3 questions I'll answer here in my bond market outlook for 2024. Let's start with why investors are so excited right now. Inflation is falling and it's likely to continue falling. Falling inflation means the Fed can lower interest rates. And they just came out and said they expected to lower them 3 times in 2024. And falling interest rates are great for bonds. So if it's all based on falling inflation, then the next question to ask is, how sure are we that inflation will fall? I would say pretty dang sure. I covered this more in depth in my inflation outlook a few weeks ago, but in short, the biggest component of the inflation is housing, which makes almost 50% of CPI. Housing operates with a lag because it's based on survey data where they ask people how much they think they could rent their homes out for. And people don't really know the value of their home in real time. However, if we look at real-time data from Zillow, we can see that house prices and rents have been pretty much flat over the past year. And that should be reflected in the CPI housing figures by mid-2024. In addition to the fact that by far the biggest component of CPI is likely to come down a lot, we also have about half of the other components rising at a rate of 2% or less, and 9 of the 10 leading economic indicators are pointing flat or down. It would be highly unlikely to get rising inflation in a slowing economy. To bolster the case even further, the Fed's preferred inflation measure, PCE, and the more important core PCE, both fell at rates at or below their 2% inflation target over the past 6 months. So if inflation is almost certain to come down, and that means they can lower interest rates, bonds should be great, right? Well, yes, maybe, probably, some of them, but there are some key risks that the market is ignoring, and I'll highlight 2 of them here. First, it's all about what's priced in. This is one of the key lessons in investing to always remember. The market is forward-looking, and that goes for stocks, bonds, real estate, commodities, currencies, everything. The market prices in what is expected to happen in the future. And then future price moves will be based not on what happens, but on what happens relative to what was expected to happen. That's why you can see headlines like, company grows earnings at record pace, stock price falls 10%. Because if they grew earnings at 20%, but were expected to grow earnings at 30%, that's great in a vacuum, but worse than what was already priced in. Here's how it can work in bonds. Back in February 2023, I said, between 6 months and a year from now, the market is expecting the Fed to cut interest rates by nearly 100 basis points. I think there's a good chance the Fed doesn't cut rates as quickly. That would send rates higher in the intermediate part of the yield curve, meaning more downside for bond prices. For me in bonds, it means I want to focus on the shorter term part of the curve right now, like in 6-month or 1-year bonds. After that video came out, the Fed raised interest rates as opposed to lowering them, and just as I predicted, short-term bonds went up while intermediate and long-term bonds got crushed. So what's priced in is very important. Right now, the Fed says they're expecting to cut interest rates 3 times in 2024, or by 0.75%. That's 75 basis points. However, the market is pricing in more like 6 interest rate cuts, or 1.5% worth. I'm probably more in the camp of the market's prediction because I think inflation will fall faster than expected, and I think the economy will slow down, which will have further downside pressure on interest rates. However, given that the market is already pricing in a pretty rosy scenario, there's limited upside and enhanced risk in intermediate term bonds from here. Just like the positive earnings example I gave earlier, if the Fed cuts rates next year, that should be good for bonds in a vacuum. But the market is expecting 6 rate cuts. So if they only get the 3 that the Fed is planning on, that will be worse than what's currently priced in, and intermediate term bonds, like around the 5-year part of the curve, could fall. I'm not confident that will happen like I was last February, but it's a key risk that bond investors should be considering heading into 2024. The second risk the market is ignoring has to do more with 10-year bonds. We're in somewhat of a unique environment from 2008 to 2021, and I'm not sure we're going back to that. What I mean is, the Fed started a massive quantitative easing plan, which meant they bought trillions of dollars of long-term bonds, which artificially drove their yields down. Before the great financial crisis in 2008, it was pretty common for 10-year real interest rates to be in the 2 to 3% range during normal times. The real interest rate is just the interest rate you see, which is called the nominal interest rate, minus inflation. So if I'm right and inflation falls to around 2.5% and you have a 2.5% real interest rate on 10-year treasury bonds, that would mean they'd have a 5% yield. But after the rally over the last 2 months, the 10-year yield is now only 3.9%. So even if inflation keeps gradually falling to 2.5%, and the Fed cuts short-term interest rates a few times, there's no guarantee that long-term interest rates will come down. In fact, they might go back up. Again, this is a key risk to consider for bond investors heading into 2024. So what are the most attractive and least attractive areas of the bond market? There's a lot of uncertainty, but here's how I look at it. Anything with a lot of credit risk, I'm generally not interested. That's high yield bonds and floating rate bonds, for example. Those tend to be correlated with the stock market. And in my opinion, the stock market is expensive and investors are overly optimistic right now, despite a weakening economy. High yield bonds are not where I want to be. As far as core bond funds that are higher quality, but focus a lot on the 5 to 10 year part of the yield curve, that's also a spot I don't want to be. That goes for longer term bond funds as well. Now, I will say that over the next 2 to 3 years, I think core bond funds should do well. And if you don't want to manage your bonds that actively, it's good to just find a good core bond fund, park your money there, and call it a day. There's also certainly some near-term upside in longer term bonds if we have a recession or rates fall more than expected. So if that's your take, go for it. More power to you. I just don't have a strong opinion about whether rates will fall more than what's priced in or not. So when I think about what bonds I want to own, do I want to take more risk when I don't expect a higher return? I could easily see intermediate and long-term bonds doing either better or worse than short-term bonds. So since they have more risk, I would prefer to stay focused on short-term bonds. I think the most likely place for rates to come down is at the short end of the yield curve. That's virtually a guarantee in 2024. You get way less upside potential with those, but also way less downside risk. And because the yield curve is so inverted, you get paid way more to take less risk in short-term bonds. Since I've been trimming a lot of my equity positions lately, I've been parking a lot of my cash in ULST, the SPDR SSGA Ultra Short-Term Bond Fund ETF. With an average maturity of less than 1 and a yield of about 5.5, plus a little extra upside potential if treasury yields start to fall, this is the most attractive way to invest in bonds for me heading into 2024. And last thing, I want to say thanks for watching. If you want more free investment insight from me, check out the link below to my free Discord. It's in the description. And also, I did do a 2024 housing market outlook video and a 2024 stock market outlook video. If you're interested in those, check those out. I'll see you in the next video.